Monopolies don't help build markets or work with competitors to make a market better for all customers, but instead use unfair advantages like political strength or unfair practices, and they put competitors out of business. In many cases, don't provide for the resources for the community behind them, like paying their fair share of taxes. One example is Amazon. Amazon really grew initially. Their biggest advantage was not having to charge sales tax or not charging sales tax, which gave them a 5 to 7% advantage in the state of California. And by the time the state and local governments got together with them to force them to pay the taxes, they were so big, they put all kinds of booksellers out of business. And that's what a monopoly does. It uses its power, it uses unfair practices for its advantage at the expense of other people. And in many cases, it's a bad actor. That's been happening in real estate my entire career. Lately, Zillow and Redfin have been the big bullies, but we have a new big bully now, Rocket Mortgage. What's this going to do for the market? What are they doing? And how can we watch them along the way to understand what they're doing? Well, let's take a look at that. I'm Bill Gross. This is my weekly podcast. I'm at Bill Gross Probate on social media. I'd love to have you call me, text me, email me. If you like this video, please like and subscribe. We do a new issue of this every video every Monday morning. Now, let's talk about the overall economy first, the overall real estate economy, so we can see where we are and how this plays into it. One of the good news is, for all the excitement about the stock market dropping, for those of you who have a lot of stock, I have stocks, it's not good. But what is good is a drop in interest rates. And so you have rates drop to 6.60 closing on Friday, 6.7 the prior week. Not a huge drop, not as dramatic as the stock market, but headed in the right direction. I think lower is better overall, healthier overall. I think where we're at now has been healthy for too long. We're still at the middle of where we've been for the last year or so. So we have a market that's significantly good enough for buyers to come in the market, and buyers who lock in rates if they expire won't be hurt if they have to relock again because the rates haven't gone up. If anything, they've gone down. It works to their benefit. Now, there's two sides of the economy. There's supply and demand. Demand's the mortgage rates. The supply is the inventory. How's the inventory? Well, similarly, inventory is very tight. Now, we don't have new numbers yet from the month of March. We're still working on February numbers. But overall, inventory is still, if you look at this chart, it's higher than it's been the last couple of years, but don't let that panic you. These are the COVID years. We're still the lowest by far of any pre-COVID period. Until that changes, we can't have any kind of real estate related crash or fallout. Now, there will be times when prices drop in certain markets, but overall, nationally, that's not the case. Now, in LA, where's the market? Well, it's still pretty much the seller's market, slight, not too much. 37 has been where we've been for a couple weeks now. This is Altos market data. They do a great job of summarizing all the data points. You can see the median list price is starting to rise. But on new listings, it's maybe staying the same or coming down a little bit. Price per square foot is going up a little bit as things are more costly. Average days on market still staying down low. So overall, mixed market, but slightly to the seller's advantage, and that's where we've been for quite a while. So overall, I would say we have a seller's market that continues to be the case, it looks like, going forward. Now let's get to the news. One of the biggest news stories of the week was the same company that bought Redfin, which is Rocket Mortgage, is buying Mr. Cooper. Now, Mr. Cooper is a company that if they were servicing your mortgage, if they're the people you're paying, you might know who they are. They service about 1 in 6 mortgages in the country. They're predominantly done by companies that don't service their own loans. So typically not banks, typically not major retail-focused mortgage lenders, typically mortgage wholesalers and brokers who sell the servicing because they get some value for that they can put into their operation. And so Rocket Mortgage, which has really in the past tried to be a consumer front business, has done such a poor job of service. They're really such a lousy lender. I can say this as a realtor who's seen many offers from them and has tried to work with them. They really are so inferior in their service to the realtor community, to buyers of real estate, that they have to work kind of anonymously and kind of fool you to work with them. So they're buying Redfin hoping that you're dumb enough to use the Redfin excitement of finding a house you want to get to pre-qualify and work with Rocket Mortgage. And then now what the thought here is that Rocket is buying Mr. Cooper, which therefore, if somebody else did your home loan and you're paying Mr. Cooper, somehow Rocket will find out about it and offer you to refinance or to buy a house through them or to buy through Redfin. Somehow they use the data in a very creepy way because they don't really build relationships with consumers one at a time. Their whole business is using their muscle might. And I think cheating the rules on the edges a little bit is going to be how they're going to find this to be a profitable venture for them. So they're buying. It's interesting. Mr. Cooper, many people don't know about, is worth about 4 times as much as Redfin. This is a $9 billion acquisition and gives Rocket Mortgage access to 1 in 6 mortgages across the country. So a home seller might have their home and be paying Wells Fargo, Bank of America, some other company. But if Mr. Cooper is a servicing company, somehow Redfin wants to use that information to get a chance to sell the property or list the property. The whole thing to me just seems very, very creepy. Now, what do other people think about it? Well, their biggest competitor, rather than saying, "Hey, we need to up our game," or "Good luck to them," or this is Matt Ishbia, who is the CEO of their large competitor UWM, which is a wholesale lender as well. He says that he will offer a discount to get loans away from Mr. Cooper because he feels that they are so bad. And so this is a very unusual response in corporate America, that Mr. Cooper and Rocket really have to be disliked intensely. I do not remember ever seeing a billion-dollar company basically call out a competitor with such antagonism before. I mean, if you know an example, let me know. I'm pretty much up on story, but I understand why, because who's Rocket Mortgage? Well, Rocket Mortgage is another one of those global companies that is all about making a profit, and if it means destroying our economy in the process, they're kind of like the Zillow and the Redfin and the companies that buy companies here in America and ship all the jobs overseas. And yes, people here's lives are destroyed, but they make a good profit on their stock. And those companies are typically owned by Vanguard and by JP Morgan Chase. And BlackRock, of course, right there. BlackRock a little low. They'll probably up their money now that Rocket Mortgage is going full monopoly power. State Street is always one of those companies. So basically, you don't see any founders. You don't see managers. What you see is, in fact, I'm sorry, I had the wrong chart, because this is only institutional holders. But what I can say is that only 7.2% of the shares are held by insiders, by managers and corporate people. The company I work for, eXp Mortgage, eXp Realty, is a publicly traded company where over half of the stock is owned by insiders, the founder's wife, managers, real estate agents like me. So it's instead of a company stock benefiting their employees or benefiting community, in this case, it just benefits globalist powers. And so that's why a company like Rocket will buy a company and use its monopoly power to destroy competition. And along the way, like Redfin, I don't think they ever paid federal taxes, or maybe one year did. And like Zillow, same thing, doesn't pay taxes. Another Wall Street darling company that doesn't pay its share of federal taxes, but it's worth billions of dollars, is Compass. Compass, I believe, is the largest real estate company by dollars sold. And so they're now on a track. Now, again, this is a huge corporation with billions of dollars. The CEO's paid $7 million a year for a company that pays no federal taxes. They can't afford to pay $10 towards food stamps, but somehow the CEO gets $7 million a year. And they're worth billions of dollars. All the investors make a lot of money. And so what they want to do now is, I think, kind of lie to the market or mislead the market into saying the best way to sell your house is not telling other agents but us. Let us secretly market your property just amongst Compass agents because we're better. And as a result, you'll get, and they actually have the audacity to tell you, you'll get a better price, it will sell faster, you'll have less price reductions, if only we list the property. And so let's read Robert Refkin. We're working with our agents and their clients to create a company that better serves homeowners. No, they're not. If you read the financials, this whole scheme is because Compass makes more money when both sides are Compass. They get a better commission split. Of course, more revenue stays in-house. And in a tight market like we live now with very low listings, they want to give advantages to their own agents. And so the genesis of this was, how can we make more money as a company? The genesis is not how we better serve the customer. Now, how do I know that? Well, let's take a look at their website. And they claim And here he is. He's a very nice guy, very well spoken, very glib, blah, blah, blah. Okay, so they're given the same advantages as real estate developers and professional home builders. Note, these are people who are not in real estate sales, not real estate investors, but developers and home builders. A little different, kind of interesting take that they want you to think of yourself as a developer and a home builder, not as an investor, where most people look at the house as an investment and as a source of wealth. And so the strategies they have are not new or novel, which is true. This strategy of hiding your listings from the market to the disadvantage of your clients so you can make more commission. This has been a strategy that greedy real estate agents have used as long as they've been in the business for 40 years. And so then they list off 4 reasons why you should consider it. One is you can test aspirational pricing, meaning if we don't know the price of the property and make a mistake, we've only told ourselves that, we haven't shared it with the broader market. Not sure how testing in a limit with only your fellow agents is better than testing in the real market. Normally in a test of data, you want to have a sample that's representative, not a sample that's not representative. The second is really the key, harness the power of pre-marketing. What they want you to believe is somehow showing the listing only to their agents is more powerful than showing every agent in the business. When I put a new listing in the MLS, it seemed like immediately all 100,000 members in the area see the listing, because I get phone calls, texts, emails, and not from my company, in fact, rarely from my company, because my company is less than 5% of the market as a whole, just like Compass. And so all the agents see a listing, all the buyers see a listing through the myriad of websites. But what companies are saying is we can just hide it amongst ourselves and give ourselves 7 or 10 day head start. Somehow that will work to your advantage. And then I got to give them credit for gall and audacity. They actually, and I'm a master of data if you know me at all, they list out what they're going to do, and then they try to hide down below, here's the numbers. So what I want to say is our research shows, our research. When a company says our research, they're not even pretending to say it's some fake organization. So there's 3 levels of research. There's real research done by an independent third party. There's research done by third parties that are captive, like when a company hires a company to do research for them, the company knows you better find what we want you to find so we can market it. Otherwise, we're not going to renew the marketing materials and such. And then there's the our research. This is the fakest of it all. They even pretend to be legitimate. Our research shows a 2.9% higher closing price, faster to contract by 20%. I'm not quite sure how you really track that. It'd be maybe less time to contract, but not faster, and then less likely to drop in price by 30%. Well, to me, what it tells me is that somehow they fooled people into paying too much and or got into escrow faster. But interesting, there's no real data here for you to evaluate. Normally, when you do research, you offer the data, and it goes behind that. And so if you scroll down, you'll see in very small print, on purpose, all disclaimers here. And it kind of tells you this was done by their own data, and they're not sharing it, it's not available. Okay, I would love to see it. I'll give them, I'll give $500 to their favorite charity for a copy of the spreadsheet of the data to analyze, to actually look at it. They would never give it to me. But you'll notice it says, the finding may vary on market conditions and seasonality. The results provided are based on current data and methodology and should not be interpreted as definitive predictions of future outcomes. Should not be. Should not be. So, yes, of course, any data only documents the past. But if you can document reasons why something is true, if inherently hiding your listing from agents was better, you at some point could prove the theory that it will lead to better outcomes. In this case, they can't do that because it's obviously stupid, right? Nobody really believes that if you hide the listing from the majority of agents in a market, in fact, 95% or more, if you hide it from them, then you're really going to get a better outcome. Nobody really believes that. They just say it. And one thing we've learned in our current environment, if you just say things, people don't really think about it. They hear you go, oh, wow, yes, that sounds reasonable. If you say it with conviction, if you practice your script a lot, it'll come across. But you read what they're saying in the data, and the truth is it really has no basis at all. Now, what could pass as data? Well, for example, here's the MLS. When I say the MLS is really hundreds and thousands of participants, the MLS. There's different MLSs. One of the MLSs, one of the larger one is Bright MLS, and they have a research department called Bright Research, and they actually did a scientific study, and this is what a study looks like, and they release it to the public, and they release their data underlying the study so that other people can compare it and try to invalidate it. And what they came up with, it's interesting, because what they're not saying is that hiding the listing is inherently worse. What they are saying is that you really can't determine that, and they make several reasons why that's true. But what is clear is it is bad for the market overall. It's obviously bad for buyers, because if there's less listings on the market, then unless every buyer signs up with Compass, which is obviously their goal, and that's never going to happen. It's never going to happen that way. But that's what happened. Unless it happens, buyers will have less properties to look at. That's obviously bad. And less transparent data. If the listings are just done between Compass agents and never go to a third party to register, then we don't really know what they sold for, concessions and prices and details of the property. And there's also a lack of enforcement of ethical standards between agents as well when we have a third party. And so what they point out is that it's terrible for the economy overall. It's bad for customers overall. And that's indistinguishable as to whether or not it's good or bad for their individual sellers. And I think, again, Compass's claims are cute. They're, hey, good on you for being aggressive. But I just don't think that it passes the smell test. I don't think anybody really believes that. Okay, speaking of data, and here's a case where you have really good data, kind of, but not. A report came out this week regarding the Measure ULA, or the mansion tax here in Los Angeles. It was done by UCLA. Now, it's important to note that UCLA does get a lot of revenue from property tax around the state. So this is kind of like a heroin addict saying to the heroin dealer, yeah, no, you guys are really good. We appreciate you. But because UCLA is a school, they have to at least pretend to be somewhat academic, and so they do. But UCLA gets so much money from politicians, they have to always side on the politician side. So they have a real tightrope here to walk. And so it's a great study, the unintended consequences of Measure ULA, because they don't want to, but what they have to document, just the data shows, the sales plummeted at the over 5 million mark, not just of residential sales, but commercial, industrial. Many people didn't realize, they got people to vote against the nasty, wealthy people on those $5 million mansions. But what they didn't tell you was that if you had a 50-unit apartment complex that sold for $6 million, mostly lower income personnel, that also is subject to the tax. They're taxing poor people's rentals, which in turn cause landlords to try to pass those rents on to those tenants. And so the whole thing, the whole mansion tax is a fraud. And then now we're trying to go back after the fact and say, well, what happened? And the result is sales over $5 million plummeted to the point where, and this is the thing that's fascinating. I have the report up here. Let me bring it up on the stage. So here's a report from the UCLA Lewis, and I knew Lewis Homes. I knew the owners, great people. They spend money and endow UCLA with money to do this research. And then UCLA, I think, just squanders it because they become so beholden to the politicians where they get the revenue that they take this data and actually lie about it. I'll show you what I mean. If you read the summary, there's no mention of this fact, because the real question is, did the measure raise or lower property taxes? The answer is, spoiler alert, less property taxes were collected after raising the rate on those bad mansions. How can that be? Because sales plummeted. If you take the report and it's 53 pages and download it like I did, you'll find out that on page 48, and I did this before the call, before I did the video, let me just scroll down here. Or was it 44? Let me see real quick. Hidden way down here with no headline is, I'm sorry, page 45. Here we go. Lower property tax base translates to an estimated $25 million per year in foregone property tax growth. Money that schools, city services, and other crucial programs would have otherwise received. So the city got $25 million less as a result of raising taxes. And this is an important point of the debate is, we're always told raising taxes gets more revenue, but that's not the case. Oftentimes, raising taxes causes people not to do something to avoid the tax. In this case, people with houses over $5 million, maybe they owed $4 million on it. They'd borrowed money for whatever purposes. At some point, say, I don't want to pay an extra 5% in taxes, an extra $25,000. I just won't sell. I'll keep it. I'll rent it. I'll give it to my kids. And so the city actually lost. Here is a case where the tax was designed to tax the rich And as a result, the rich just sold less homes and less properties and less multifamily properties. There's $25 million less revenue as a result. This is a time when the city of LA has $1 billion shortfall. We're going to be laying off firemen, policemen. They're going to tell you how terrible it is, and we need to raise more taxes. What they won't tell you is, will the taxes they raise actually raise more taxes or drive more people out of the city? And it says, moreover, if ULA continues to reduce probability of higher in transactions occurring in subsequent years, within a decade, the annual cost and lost property tax revenue could be in the low hundreds of millions of dollars. Now, you'll notice there's no paragraph. This isn't in bold, right? This isn't the chapter heading. This is kind of hidden in the data by UCLA. Because why? Because UCLA are all, they're all part of the city, county, state political atmosphere. You can't be a state-run school unless you support the state government, the governor financing you. And so at the risk of biting the hand that feeds them, what happens is you have education taken over. And here's a perfect example. Rather than UCLA Lewis School having the courage to say the headline out loud, the unintended consequences is this program worked in the exact opposite direction it was intended. It took equity from people who had the right to property. It caused less home sales. Lots of jobs are lost because every home sale you have brokers who get paid, you have repairmen who get paid, painters that get paid, repairs are being done, not being done in this case because houses aren't sold, and you have 25 million. You have less revenue at the end of the day. At a time when the state and the city are suffering, we have less revenue, and UCLA has had the courage to tell the truth. And this is hidden. They do the headline because what is clearly true is the number of sales dropped dramatically. That's even worse. People can't sell their houses because of this tax, but they don't care about that. But the revenue part they care about, and even that has been a catastrophe, I think, for our city. Okay, and so just continuing to show then, what happened was we took this money from the rich and we're going to give it to help homeless. And now that program is so bad. I've previously reported how that the executive of LASA was overpaid and she's giving money to a company or organization where her husband works. What a disaster it is. We have $20 billion in California spent on homeless we can't find. We have billions of dollars in LA spent on homeless we can't find. They say the homeless numbers are going down. I don't know. I drove around today. It looks to me like more than ever. It's so bad. It's so bad that the county of Los Angeles is now going to pull funding from the homeless agency as well. And so here we have this tax designed to reduce homeless. Homeless is up. The agency is a waste and a disaster. The measure got less money, not more. So you might say, well, gee, if the measure's not getting revenue, maybe we need to cancel the program. No, they're not canceling the program because there's no money. They're canceling the program because even the county admits it doesn't work. Do you realize how bold it is for one politician to tell another politician the program doesn't work, so we're going to pull out of it? Now, the truth is LA County is doing this because they want to set up their own agency. The LA County is not happy that City of LA has a homeless agency, so the county wants to have its own agency. So they're going to try to spend money to put their friends and family and overpay them in jobs that don't really do anything. And so this whole thing is just a one hand washing the other along the way. The tax is raised, less home sales, less revenue, less help to the homeless, but now we're going to end up with a second program instead of just a city program. We're going to have a countywide program as well. That's how government works in the state and local level. It's just really comical. And then to add to that, here in LA, so again, I showed you how we have less money. You might say, well, Bill, if there's less money, they're not going to spend it. No. They're spending the money, whether they get the money or not, it's spent. So they spent money on the homeless agency, and now they're going to spend more money on a right to counsel law. So what happens is every deadbeat tenant now has a legal right to an attorney paid for by the city of Los Angeles. That's what the law we're passing here in LA. It's not enough that they had a right to counsel. Anybody can hire their own counselor. It's not enough that every single deadbeat tenant, in my experience, had a nonprofit attorney for free to them, approach them, numerous in many cases. I've walked the halls in courtrooms and I've seen these nonprofits soliciting tenants to work for them. There's more people soliciting attorneys than there are people looking for attorneys. That's not good enough in the city of LA. We're now going to pay those attorneys out of taxpayer money because those are political allies to the government. And so that way, those people who are paid now become political activists on behalf of the city politicians. So here you have a program. We raise a tax to get money. The money goes down, but we still have the program. The program doesn't work, but we have now a county program, and we have another new program, right to counsel, and all this is being paid for. And meanwhile, there's no money in any of this process. So there you go. Your Los Angeles City and your Los Angeles County at work. And just to make sure that I don't just bash politicians, the companies are equally, I think, evil in these times and mistaken. Wells Fargo yet again caught cheating. And this is amazing to me. This one, I don't know how this story really didn't get more national headlines. You may remember years ago, Wells Fargo was caught cheating their customers. They were opening accounts without approval. This is separate from the JP Morgan, which was the private banker to Jeffrey Epstein, financing child trafficking and child rape. Wells Fargo was merely just caught in the past cheating their own customers by opening accounts and charging them money they should have paid. Here they're ordered to pay $832 million because they mismanaged and charged fees on a trust fund for 2000. What they don't tell you is these are Seminole Indian children, descendants of the Seminole Indian tribe. Now, I'm not a DEI guy. I'm not one of those big, hey, people of color and all that. But I would imagine you would think Democrats would be up in arms how the white man's treating the Indian badly. Literally, Wells Fargo cheated Indians. Literally, $832 million they have to pay. It's so bad that the Wells Fargo employees are also personally fined. Now, normally when you work for a company, you're not responsible for the company's mistakes unless you're personally involved in it. And this is so egregious that the jury fined the individuals nominal money, but still not fined them too, because they were cheating the recipients of trust funds set up to protect these families and these children. Just amazing, $832 million. But again, don't worry about it. Wells Fargo made $17 billion using your tax revenue and the good faith of America's banking system that you and I underwrite. They use that to make $17 billion and pay all their executives multi-million-dollar salaries. So don't worry about Wells Fargo's finances. You should worry, though, about these big banks and their continued pattern of cheating customers, cheating people, and getting away with it. So what do you think? I don't know, kind of a negative story in some regards, or maybe it's positive they got caught and the jury caught them. You tell me. Love to hear your comments. I appreciate you guys who send me notes. Shout out to Shiva on the UCLA and the ULA information. He's always one of my best. Shout out to all the people who write me comments. Please subscribe if you like this. As always, you can reach out at LAProbate. Make today your best day ever.